And it all brings us to our talk of the tape and whether today's jobs report was just right to keep the Fed from turning much more aggressive, even as it shows still strong labor market, and what it all might mean for the rally. Let's ask Charles Schwab's Ann Sonders, chief investment strategist there. Ann, great to speak with you on all this. I mean, I guess the question is, do you think the market is correct to take a little bit of comfort out of today's numbers? Essentially, we're not seeing an overheating economy, but also not one that's outright stalling.
Yeah, I suppose in the context of the nearly 500,000 ADP print, which really kind of freaked out investors, I think you can take some comfort. But of course, we're starting to see the weakening that although the Fed wants to continue to quell inflation, might be starting to send some signs of sort of full official recession versus what we've been calling the rolling recession. I think it was the slightly hotter than expected wage number and the uptick in hours worked that probably moved the needle a little bit in terms of probabilities for a July hike, which were already high, but now they're up around 95%. Beyond that, meaning September, it's the data that's going to define what the Fed does beyond July. But I think a hike is basically baked in.
Yeah, it does seem that way, certainly at this point. Although, what are you picking up in these numbers today that suggests to you that we may be now getting closer to that more broad-based formal recession? I mean, obviously there were downward revisions to prior months' job gains and then about a 40,000 job miss for June.
So you also saw the spread between household and payroll or establishment survey data. The establishment survey is what generates payrolls, and then the household survey is what generates the unemployment rate. And although that in the case of household was up, that is compared to a pretty big negative the prior month. And out of the last 15 months, 5 months have seen big declines in household employment, and that tends to lead as you're heading into a downturn in the economy. You've also seen the rolling over in temporary jobs. That also tends to be a leading indicator. And although we had a little bit of relief in terms of unemployment claims, the 4-week average is up more than 30% from the trough. And the average heading into recessions of claims is up only about 20% from the trough. So it's certainly not a done deal, but maybe a few more little check marks you can put in the recession column.